the line is that investing is the only business I know. Like, I've been doing this a long time. It's the only business I know where things go on sale, everyone runs out of the store. And the cheaper the price, the further they run. And to your point, in every other business, you put something on sale, people will run over each other to get it. But in investing, for whatever reason, when the prices start going down, people run away. And and it's a sad thing, Kelly. It's why the average investor so dramatically underperforms just a traditional passive strategy. And I'll just give you some numbers. So JP Morgan numbers, 20 years, average stock index about 9%, bonds are up about 6%. And all you had to do is pick one and you made 6 or 9, or pick 50-50 and you made 7.5, or pick some mix. The average investor, 2.5.
Mm.
What? How? Well, because human beings do two things really well. We buy what we wish we would have bought. So we wait and it goes up and we're like, oh, I was going to get it. Oh, it'll pull back. And then it goes up some more. And then we're like, oh, I next pullback. And it goes up some more. And then when the pain is too great, we just buy things, but then we don't think about, well, what does that price reflect about the value? And herein lies I think the biggest challenge of investing. Price is a liar.
Mm.
Price has nothing to do with value. The value of any asset is not its price.
Mark Yusko, founder, chief investment officer, and managing director of Morgan Creek Capital, believes the recent downturn in cryptocurrency prices is just a temporary hiccup typical of a crypto summer phase, rather than a sign of deep-rooted issues. Yusko claims that the crypto spring concluded in June. He suggests that we're now navigating in the early days of a crypto summer, which he anticipates will continue beyond the halving event in April 2024. Yusko points out that, much like past crypto summers, there will be an occasional price drop. However, he expects a trend of increasing peaks and troughs. Yusko's main takeaway is that Bitcoin's current price is a significant undervaluation. He argues that dips in price like we are currently seeing are opportunities and should be viewed as such. Yusko believes if you are excited before making an investment, you are probably doing it wrong and it will probably turn out bad. It's when there's blood on the streets and you are fearful or worried before making an investment that you will usually do well. Make sure to stick around to the end of the video where Yusko breaks down why he believes the big price surge will come April 2024. Also guys, if you want to stay most up to date on the crypto world, I send out a daily 5-minute crypto newsletter that covers expert predictions, on-chain data breakdowns, and breaking news, all for free. Click the first link in the description, enter your email, and join over 5,000 others to become a better crypto investor right now. Now here's Yusko with his Bitcoin breakdown.
If you're excited about investing, you're doing it wrong. Right? No, you are. I mean,
Yeah.
if you feel really good about things, you're doing it wrong. In fact, it's worse than that. If you make an investment and you feel good about it, you'll probably lose money. If you feel really good about it, you're going to lose a lot of money. If you make an investment and you feel a little sick to your stomach, a little apprehensive, you're probably going to make money. If you feel really sick to your stomach, you make a lot of money. And it's because by the time you and I feel good about it, it's already in the price, right? All the information's in the price. The market has already, and if you feel really good, you're buying something that everybody loves, then you've missed it. And that's why the average individual then rides it over the cliff. And to your point, the idea of not having a discipline and not having a diversified portfolio, not only just across asset classes, but within each asset class, across different assets within that asset class and different security types, and using hedging where it makes sense, and having a rebalancing discipline. So every 3, 6, 9 months, you sell your winners and you buy your losers. And you're like, no, I want to sell my losers. I want to get rid of them because I was wrong. Look, there's a difference between investing winners and losers and other types of winners and losers. And the I guess the adage is, Paul Tudor Jones, famous macro trader. There's a picture of him in his Virginia dorm room with a sign that says "Losers average losers."
Mm.
Right? And So basically what he's saying is only a loser buys more of something when it goes down, right? Okay, but wait, that's the opposite of what you just said, Mark. You're supposed to buy things when they go on sale. Difference. Paul's a trader, not an investor. It's a very big difference. And not good or bad, just different. Investors, right? People who do the work, right? Do the work to understand the value of an asset relative to its price. When the price is below the value, they must buy. And if the price moves away from fair value, you must buy more. When the price is above fair value, you have to sell. When the price is way above fair value, you have to sell a lot. Now, an investor is very different than a trader. A trader doesn't care about fair value. They just want movement. They want to scalp on the way up and they want to scalp on the way down. They're agnostic as to direction of market. And both are perfectly acceptable. Trading is really hard. The average person is not very good at it. It's because it's really hard to block out all the noise about value and what does the business do. They don't really care. If the price is moving, they're buying it. If the price is going down, they're selling it. The real problem comes in late in the cycles, and we've all seen it, when you combine trading with leverage. Right? Here's the killer cocktail. Leverage can never make a bad investment good. It can, and often does, make a good investment bad. Why? Because you're forced to sell at the wrong time. So if you get a margin call and your assets fall in 50%, you don't get to sell that asset and pay back the margin. You have to sell some other asset that hasn't gone down. Well, that's the antithesis of what you should be doing, right? If you've done your homework and this is a good asset, you would actually want to be buying more. But here's the problem. You said it. The average person doesn't do their homework. They heard somebody mention something. They don't think about, was that person being paid to mention that? Does that person have a meaningful percentage of their net worth in it? Or is it one of 100 different positions? And, now we have the internet media, it's worse because now people do get compensated for talking about things on air. I mean, I never do, but I mean, that's just, my choice. I don't want to be compensated, but I think it's an interesting dynamic when you think about crypto and why we have this 4-year cycle. And, we're in what I refer to as crypto summer right now. Well, what is crypto summer? Crypto summer is that time where the market has a generally upward drift. It's not dramatic, but slowly upward, higher highs, higher lows, just kind of, like a roller coaster, kind of moving its way up the track. And what causes that? Well, what causes that is investors like myself, I consider myself an investor, have done the work, right? We spend hours and hours and hours looking at the value models and said, okay, the Metcalfe's Law model of Bitcoin, which use Bitcoin as an example, is 55K. Now you can say, well, that number's silly. No, Tim Peterson, my buddy, has this great model. You should have him on the show sometime. He's amazing. And that model's been deadly accurate on the value of the model because any network can be determined, the value of it, based on this Metcalfe's Law and the number of participants in the network. Make a long story short, if the price at 29 is lower than 55, then as an investor, I should want to accumulate. I should want to buy, right? Well, then what happens is as we get toward the halving, that'll happen next, April, and next June we'll shift into crypto fall. In that transition post-halving, crypto fall is where the traders start to come in because we'll start to approach that fair value, and the traders just see movement. And again, it's not politically correct to talk about, but men and women turns out are different. I know everybody doesn't want to talk about that, but they are. And one fundamental difference is not having babies or not, but one fundamental difference is hunters and gatherers, right? From prehistoric times, there were hunters. And it doesn't mean they were all men, predominantly men. I guess there could have been some women hunters, but anyway. And then there are gatherers, the nurturers. Well, what's a skill you need as a hunter? You need head on a swivel, right? Because it's got all these things trying to kill you, and you're out trying to kill something.
Being
And
aware
so
of anything that's moving will always take
anything that's
precedent.
moving, like if
Yeah.
somebody walks across my, outside hallway there, I will look at. But the part is that trading is fine, and the good traders come in and they'll actually push the price a little bit, but then you get above fair value. Well, now the speculators come in, and in general, speculators are not even evil, right? What is a speculator? A speculator is just someone who takes the opposite side of a hedger. A hedger is like a producer. An oil producer sells using the futures market. Speculators take the buy, because for every sell, there's a buy. Every buy, there's a sell. That's my favorite thing when people say, "Oh, there's excess buyers in the market." No, there's not. There's
It's
an equal
exactly
number
it's
every
exactly
single day,
equal. Yeah.
precisely equal.
Yeah.
And there could be on the margin, the next incremental trader could be one or the other, but there will always be an equal number, or the market doesn't work. So then the speculators are there, and they're fine. The miners are selling their coins, and they need to sell more because the block rewards just went down, so the price needs to rise. Well, then the leverage comes in, and when the leverage comes in, speculators turn into gamblers. And the difference between a gambler and an investor is not just where in price relative to value, but also has to do with amount of work. Gamblers don't do any work. I heard that coin's good. But I find this cycle will get exacerbated and get exaggerated. And then when price exceeds fair value by so much, investors turn around and say, I'm out. I'm going to rebalance, because if I bought it early, now my weighting is really high relative to my anticipated desired weighting. And so I'm going to sell. Well, that triggers the downward momentum. Then the short sellers come in and they push it back down, and then people get margin called, and we get the collapse. But that's when the cycle starts all over.
So there's Mark Yusko on why he views the current price dips in Bitcoin as an opportunity more than anything else. To recap, we've delved deep into his perspective on the current crypto summer phase, the cyclical nature of cryptocurrency price movements, and the promising future he sees for Bitcoin. Remember his key insight: times of fear and uncertainty might just be the best opportunities for investment. If his prediction about April 2024 has piqued your interest, be sure to mark your calendars and keep a keen eye on the crypto space. Remember, education and staying informed is crucial in this rapidly evolving world. And if you haven't already, don't forget to click the first link in the description to subscribe to my daily 5-minute crypto newsletter. Equip yourself with the latest insights, expert predictions, and crucial news updates. Join our growing community of over 5,000 dedicated crypto enthusiasts. Anyway guys, hope you all enjoyed today's video and that provided you with some value. I'll see you all in the next one, and as always, all the best.